In this video, I am going to break down 5 insanely oversold stocks that Wall Street has pushed down aggressively, even though their long-term competitive advantages remain intact. By the end of this video, you will understand why these companies still dominate essential industries, how their moats continue to widen, and why temporary pessimism could set the stage for powerful rebounds. These are large-scale, cash-generating businesses embedded in cybersecurity, scientific research infrastructure, enterprise cloud computing, global commerce logistics, and financial advisory platforms. They operate in structurally growing markets, benefit from recurring revenue, and hold competitive positions that are difficult to disrupt. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first insanely oversold stock, Palo Alto Networks, ticker symbol PANW. To understand why Palo Alto Networks matters, you need to recognize that cybersecurity is no longer just an IT expense. It is mission-critical infrastructure. Every company today operates digitally. Customer data, intellectual property, internal communications, financial systems, and cloud applications are all exposed to constant threat. A single breach can cost millions in remediation, legal fees, regulatory penalties, and reputational damage. Cybersecurity spending is not optional. It is a necessity. Palo Alto Networks built its reputation in network security, but it has evolved far beyond that. The company now offers an integrated platform covering network security, cloud security, endpoint protection, security operations, and threat intelligence. This platform approach is central to its long-term advantage. Why does platform breadth matter? Large enterprises often rely on dozens of separate security tools. Managing those tools creates complexity and blind spots. Consolidating vendors reduces operational friction and enhances visibility. Palo Alto Networks has positioned itself as a consolidator by offering multiple security capabilities under one umbrella. The stock has experienced periods of sharp pullback due to macro-driven spending concerns and normalization after elevated demand periods. Investors became worried about billings growth and enterprise budget tightening. As a result, the share price moved into oversold territory relative to long-term intrinsic value estimates. But the underlying demand drivers remain powerful. Cyber threats continue to grow in sophistication. Cloud adoption increases the attack surface. Remote work expands network complexity. Artificial intelligence tools introduce new vulnerabilities. All of these factors increase the need for advanced security solutions. Financially, Palo Alto Networks generates tens of billions in annual revenue, with subscription and support revenue representing the majority of total revenue. This recurring revenue model provides stability and visibility. Subscription contracts often span multiple years, reducing revenue volatility. Operating margins have expanded over time as the company scaled its platform. Free cash flow generation has also strengthened, demonstrating that growth does not come at the expense of financial discipline. One important metric to consider is remaining performance obligations. This figure represents contracted revenue that has not yet been recognized. Growth in this metric signals sustained demand and backlog strength. It provides a forward-looking indicator of revenue visibility. Another factor supporting the long-term thesis is customer expansion. Enterprises that initially adopt one Palo Alto product often add additional modules over time. This cross-selling deepens integration and increases switching costs. Once a company standardizes its security architecture around a unified platform, replacing it becomes risky and operationally disruptive. That stickiness translates into durable revenue streams. Short-term headwinds can arise when enterprises delay new purchases or optimize spending. But cybersecurity is rarely an area where companies permanently cut budgets. Breaches are too costly, compliance requirements are too strict, data protection is too central to operations. When a stock becomes oversold, investors must ask whether the business model is broken or whether sentiment simply shifted. In the case of Palo Alto Networks, the competitive position remains strong. The company continues innovating in cloud security, automation, and artificial intelligence-driven threat detection. The market's reaction may reflect temporary deceleration rather than structural decline. Now let's examine the economics more closely. Subscription revenue creates predictable cash flow, which supports reinvestment in research and development. High gross margins typical of software businesses allow operating leverage as revenue scales. Over time, incremental revenue contributes disproportionately to operating income. Free cash flow generation provides flexibility. It can be used to fund acquisitions, strengthen the balance sheet, or repurchase shares. Strong cash generation also reduces financial risk compared to companies reliant on external capital. Another long-term growth driver is consolidation within the cybersecurity industry. As enterprises seek to simplify vendor relationships, platform providers with broad capabilities stand to benefit. Palo Alto Networks has strategically expanded through acquisitions and internal development to address this demand. Risk remains present, competition is intense, technology evolves rapidly, enterprises may negotiate pricing aggressively, but the company's scale, brand reputation, and integrated offerings create a strong competitive foundation. Oversold conditions do not guarantee immediate rebound. However, when valuation compresses while revenue continues growing and margins expand, long-term return potential improves. The key question for investors is whether the cybersecurity landscape is shrinking or expanding. All evidence suggests it is expanding. Digital transformation is accelerating, data volumes are rising, regulatory oversight is increasing, security complexity is not declining. Palo Alto Networks sits at the intersection of these trends. Now before we move to the second stock, let me quickly thank the sponsor of this video. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second insanely oversold stock, Thermo Fisher Scientific, ticker symbol TMO. If Palo Alto Networks represents mission-critical infrastructure for digital systems, Thermo Fisher Scientific represents mission-critical infrastructure for global scientific progress. This is not a trendy company. It is not driven by hype cycles. It is embedded in laboratories, research institutions, pharmaceutical companies, biotech firms, hospitals, and academic centers across the world. Thermo Fisher provides analytical instruments, laboratory equipment, consumables, reagents, diagnostics tools, and contract development and manufacturing services. In simple terms, it supplies the picks and shovels for the life sciences and healthcare industries. Whenever a pharmaceutical company develops a drug, conducts clinical trials, manufactures biologics, or runs quality control tests, there is a high probability Thermo Fisher equipment or services are involved somewhere in the process. The stock has faced pressure due to post-pandemic normalization. During the pandemic, demand for diagnostic equipment and related products surged. When that demand subsided, revenue growth slowed. Investors interpreted this deceleration as a structural decline, and the share price corrected sharply. But here is the critical distinction. Pandemic revenue was temporary. The core business was not. Thermo Fisher's long-term growth drivers remain intact. Global healthcare spending continues to rise. Aging populations increase demand for medical innovation. Biotech research expands. Personalized medicine grows. Governments and private institutions invest heavily in scientific research and development. Thermo Fisher operates with a diversified revenue base across instruments, consumables, and services. Consumables are particularly important because they create recurring demand. Once a laboratory installs Thermo Fisher equipment, it typically continues purchasing reagents and supplies compatible with that system. This creates a razor and blade model. Instrument sales drive installed base growth. The installed base drives ongoing consumable revenue. Switching costs are meaningful because laboratories calibrate processes, train staff, and validate workflows around specific equipment platforms. Financially, Thermo Fisher has historically delivered consistent revenue growth combined with disciplined cost management. Operating margins have remained strong relative to industrial peers due to scale advantages and product differentiation. Free cash flow generation has also been robust. The company uses cash strategically to fund acquisitions, expand capabilities, and strengthen vertical integration. Acquisitions are a key part of the Thermo Fisher strategy. Management identifies complementary businesses that enhance product breadth, geographic reach, or technical capabilities. Over time, this builds a more comprehensive offering, making Thermo Fisher a one-stop partner for customers. When investors view the recent slowdown, they often anchor on peak pandemic revenue rather than normalized trends. That creates distorted expectations. Once growth rates normalize, sentiment weakens even if the long-term trajectory remains upward. Oversold conditions can emerge when short-term comparisons overshadow structural demand drivers. Risk factors exist. Research funding can fluctuate. Pharmaceutical pipelines can experience setbacks. Capital equipment spending may pause during economic uncertainty. But the global trend toward innovation in life sciences remains powerful. Now let's turn to the third stock in our analysis. Microsoft, ticker symbol MSFT. Microsoft is one of the most dominant enterprise technology platforms in the world. It spans operating systems, productivity software, cloud infrastructure, gaming, enterprise solutions, and artificial intelligence integration. Yet even dominant companies experience periods of valuation compression. Rising interest rates, macro uncertainty, and concerns about enterprise cloud spending have periodically pressured large-cap technology stocks, including Microsoft. To understand Microsoft's resilience, you need to examine its business segmentation. The company operates across three primary segments: productivity and business processes, intelligent cloud, and more personal computing. Productivity and business processes includes Office 365, LinkedIn, and Dynamics. These tools are deeply embedded in enterprise workflows. Subscription models generate recurring revenue with high gross margins. Intelligent cloud includes Azure, server products, and enterprise services. Azure is a major cloud infrastructure platform competing with Amazon Web Services and Google Cloud. Cloud infrastructure remains a long-term growth engine as enterprises migrate workloads from on-premises data centers to scalable cloud environments. More personal computing includes Windows licensing, Surface devices, and Xbox-related revenue. The most important structural driver today is cloud and artificial intelligence. Azure continues expanding as companies adopt hybrid cloud strategies. Enterprises rarely shift all systems at once. Instead, they gradually move workloads to the cloud. Microsoft benefits from long-standing enterprise relationships and integration with its broader software ecosystem. Artificial intelligence integration represents another growth vector. Embedding AI capabilities into productivity tools, developer platforms, and cloud services enhances pricing power and drives incremental demand. From a financial perspective, Microsoft generates enormous operating cash flow. High gross margins combined with subscription revenue provide exceptional operating leverage. Even moderate revenue growth can translate into meaningful earnings expansion. The balance sheet is strong, with substantial cash reserves. This reduces financial risk and allows ongoing investment in infrastructure, research, and acquisitions. Why would such a dominant company become oversold? Valuation compression often occurs when growth expectations reset. If investors previously assumed hypergrowth and growth moderates to steady expansion, multiples contract. That does not necessarily mean the business deteriorated. It often reflects recalibration of expectations. For long-term investors, the question becomes whether Microsoft's competitive advantages are eroding or strengthening. Its ecosystem integration remains powerful. Enterprises rely on its productivity suite daily. Developers build on its platforms. Cloud contracts are multi-year commitments. Switching costs are significant because businesses would need to retrain staff, migrate data, and redesign workflows. Risks include competitive pricing pressure in cloud services and regulatory scrutiny, but scale advantages, brand strength, and integration across software layers provide defensive depth. When strong companies face temporary multiple compression while continuing to grow revenue and cash flow, long-term compounding potential can re-emerge once sentiment stabilizes. Now let's move to the fourth insanely oversold stock, Amazon, ticker symbol AMZN. Amazon is often misunderstood because investors look at the company as a single entity. In reality, Amazon is a collection of powerful businesses layered on top of one another. Each business has different margin profiles, capital requirements, and growth trajectories. When the market becomes nervous about consumer spending, logistics costs, or macroeconomic slowdown, Amazon's stock often becomes volatile. That volatility can create oversold conditions even when long-term structural advantages remain intact. To properly analyze Amazon, you must break it into three primary engines. First is the e-commerce retail platform. Second is Amazon Web Services. Third is advertising and high-margin services layered on top of retail traffic. Let's begin with the retail engine. Amazon built one of the most sophisticated fulfillment and logistics networks in the world. Warehouses, distribution centers, last-mile delivery capabilities, and advanced inventory management systems form a massive physical infrastructure moat. This infrastructure is expensive to replicate. It took decades and tens of billions in capital expenditure to build. Smaller competitors cannot easily match the scale, delivery speed, or geographic coverage. However, retail margins are typically thin. Shipping costs, labor, and infrastructure investment compress operating margins. During periods of inflation or supply chain disruption, profitability can temporarily decline. That is exactly what happened in recent years. Investors saw rising fulfillment costs and slowing online growth after pandemic-driven acceleration. The stock corrected sharply as fears of structural margin pressure intensified. But here is the strategic insight. Retail scale feeds higher margin segments. Every customer transaction generates data. Every visit creates advertising inventory. Every third-party seller increases selection and enhances marketplace liquidity. Now let's examine Amazon Web Services. AWS is a cloud infrastructure platform providing computing power, storage, databases, and analytics tools to enterprises. It is structurally different from retail. Gross margins are significantly higher. Operating leverage is powerful once infrastructure is deployed at scale. Cloud adoption remains a long-term secular trend. Enterprises continue migrating workloads to the cloud to reduce capital expenditure and increase flexibility. Even when growth rates moderate during economic slowdowns, the overall trajectory remains upward. AWS has historically generated a disproportionate share of Amazon's operating income relative to its share of revenue. This makes AWS the profit engine supporting reinvestment across the broader ecosystem. When cloud growth decelerates temporarily, investors often extrapolate that slowdown too aggressively. But enterprise cloud contracts are typically long-term and mission-critical. Companies rarely reverse cloud migration because doing so would disrupt operations. The third engine is advertising. Amazon's platform captures high-intent shoppers. When consumers search for products, advertisers are willing to pay premium placement fees to appear at the top of results. This advertising business carries significantly higher margins than first-party retail. It monetizes existing traffic without requiring proportional increases in fulfillment expense. Now consider the strategic layering. Retail drives traffic. Traffic drives advertising revenue. Cloud infrastructure drives high-margin enterprise income. Membership programs such as Prime increase customer loyalty and recurring revenue. Prime is particularly important because it increases purchase frequency. Subscribers are more likely to default to Amazon for purchases due to perceived shipping benefits and ecosystem integration. Financially, Amazon generates massive operating cash flow over time, even though capital expenditures fluctuate. Investments in warehouses, data centers, and logistics temporarily depress free cash flow but strengthen competitive positioning. When the market evaluates Amazon during heavy investment cycles, margins may appear compressed, but those investments often expand long-term moat depth. Oversold conditions can arise when investors focus on near-term operating margin declines without incorporating future operating leverage. Now let's transition to the fifth stock, LPL Financial, ticker symbol LPLA. LPL Financial operates in a very different industry from the previous companies. It is a leading independent broker-dealer and investment advisory platform. It provides technology, clearing services, compliance support, and back-office infrastructure to financial advisors. Unlike traditional wirehouses, LPL supports independent advisors who want autonomy while leveraging centralized infrastructure. The company earns revenue primarily from advisory fees based on client assets, commissions, and interest income on client cash balances. Why would LPL become oversold? Interest rate fluctuations can create volatility in net interest income. Market downturns reduce client asset values, which lowers advisory fee revenue. Investor sentiment toward financial services companies often deteriorates quickly during periods of uncertainty. However, long-term structural drivers remain compelling. First, there is an ongoing migration of advisors away from large traditional brokerage firms toward independent models. Advisors seek higher payout rates, greater flexibility, and ownership over client relationships. LPL benefits from this shift because it offers scale without forcing advisors into rigid corporate structures. Second, demographic trends support asset growth. As individuals plan for retirement and manage wealth transfers, demand for advisory services persists. Even during market downturns, long-term savings and investment planning continue. Third, operating leverage plays a role. As asset levels grow over time, incremental revenue can flow through at attractive margins because core infrastructure is already built. LPL also invests heavily in technology platforms that enhance advisor productivity. Better digital tools improve retention and attract new advisors to the platform. Risks include market volatility and regulatory oversight. But the independent advisory movement has been persistent over many years, suggesting structural momentum rather than temporary trend. When market sentiment weakens, financial stocks often become oversold quickly. Yet if client assets recover and advisor recruitment remains strong, earnings power can rebound. Now let's step back and connect the 5 companies discussed across parts 1, 2, and 3. Palo Alto Networks operates in cybersecurity infrastructure. Thermo Fisher Scientific supports life sciences research. Microsoft dominates enterprise software and cloud. Amazon integrates retail, cloud, and advertising ecosystems. LPL Financial empowers independent financial advisors. Each company operates in an essential domain. Each benefits from recurring revenue components. Each has switching costs or infrastructure advantages. And each has experienced valuation compression due to macro concerns or growth normalization. Oversold does not mean risk-free. It means sentiment may have shifted more dramatically than underlying fundamentals. Now that we have broken down all 5 companies individually, let's synthesize what this actually means for you as an investor. Oversold stocks are not automatically bargains. Sometimes stocks fall because businesses deteriorate structurally, revenue declines permanently, margins collapse, competitive moats erode, debt overwhelms balance sheets. But that is not what we have examined in this series. We analyzed companies operating in cybersecurity, scientific research infrastructure, enterprise cloud computing, global commerce ecosystems, and independent wealth management platforms. These are not shrinking industries. These are structural pillars of the modern economy. Let's frame this clearly. Palo Alto Networks operates in a world where cyber threats increase every year. Thermo Fisher Scientific supports a global healthcare and biotech ecosystem that continues expanding. Microsoft powers enterprise productivity and cloud infrastructure across industries. Amazon controls one of the most advanced logistics and digital commerce ecosystems ever built. LPL Financial benefits from the long-term migration toward independent financial advisory models. The key pattern across all 5 companies is recurring revenue combined with structural demand. Recurring revenue matters because it creates visibility. Visibility reduces uncertainty. Reduced uncertainty increases long-term valuation stability. Now let's examine valuation psychology. When interest rates rise, investors discount future cash flows more aggressively. Growth stocks experience multiple compression even if earnings remain stable. When macro headlines dominate financial media, sentiment shifts rapidly. Portfolio managers de-risk. Retail investors panic. Momentum traders exit positions. The result is often price dislocation. Price dislocation occurs when market price diverges meaningfully from intrinsic value due to emotional or macro-driven factors rather than fundamental collapse. Consider Palo Alto Networks again. If cybersecurity demand continues rising over the next decade and the company maintains competitive positioning, temporary growth deceleration does not permanently impair intrinsic value. It may reduce near-term multiple expansion, but it does not eliminate long-term cash flow potential. Thermo Fisher Scientific may experience cyclical research funding pauses, but global medical innovation is not reversing. Drug pipelines continue developing. Biologics manufacturing expands. Personalized medicine advances. Microsoft may see Azure growth fluctuate quarter to quarter, yet enterprise cloud penetration remains incomplete globally. Artificial intelligence integration continues embedding into enterprise software stacks. Amazon may encounter margin pressure during heavy investment cycles, yet its infrastructure depth and ecosystem layering create long-term optionality across retail, cloud, and advertising. LPL Financial may experience earnings volatility during market downturns, yet advisor independence trends and demographic wealth shifts continue unfolding. Now let's talk about asymmetric opportunity. Asymmetric opportunity exists when downside risk is limited relative to upside potential. It does not mean no risk. It means the potential reward outweighs the probable downside if the business remains intact. When high-quality companies with durable competitive advantages trade at compressed valuation multiples, long-term expected returns improve. That improvement does not guarantee short-term gains. Markets can remain pessimistic longer than expected, but over multi-year horizons, earnings growth and cash flow generation typically drive stock performance. Another important concept is operating leverage. All 5 companies demonstrate some form of operating leverage. Software platforms like Microsoft and Palo Alto Networks benefit when incremental revenue flows through at high margin once infrastructure is built. Thermo Fisher benefits from installed base expansion driving recurring consumables revenue. Amazon benefits when fixed infrastructure investments support growing transaction volume and higher margin advertising expansion. LPL Financial benefits when asset levels increase across a largely fixed support infrastructure. Operating leverage amplifies earnings growth during recoveries. Now, let's address risk management. Even high-quality oversold stocks require disciplined portfolio allocation. Concentration without analysis can create volatility that investors are emotionally unprepared to handle. Diversification across industries reduces idiosyncratic risk. Understanding balance sheet strength, debt levels, and free cash flow sustainability protects against structural deterioration. Investing is not about predicting next quarter's earnings. It is about estimating long-term cash generation and paying a rational price for it. Markets frequently overreact in both directions. They overvalue growth during optimism. They undervalue durability during pessimism. Your edge as an investor is patience combined with analysis. Instead of asking whether a stock will bounce next week, ask whether the company will likely generate more cash 5 years from now than it does today. Ask whether its competitive position is strengthening or weakening. Ask whether temporary macro conditions have created an entry point that did not exist when sentiment was euphoric. If the answer points towards structural strength and valuation compression, the probability of long-term compounding increases. Let's summarize the core thesis of this entire breakdown. We are not chasing hype cycles. We are not speculating on unproven business models. We are analyzing established companies embedded in essential systems. Cybersecurity is not optional. Scientific research infrastructure is not optional. Enterprise cloud computing is not optional. Global digital commerce is not optional. Wealth management and financial advisory services are not optional. When essential systems meet recurring revenue and competitive moats, long-term durability often follows. That does not mean prices cannot fall further in the short term. Volatility is part of equity investing, but volatility without structural deterioration can create opportunity. Before you make any investment decision, evaluate valuation metrics relative to growth expectations. Examine free cash flow yield. Assess balance sheet strength. Consider competitive positioning. Avoid making decisions based purely on headlines or fear-driven narratives. The market rewards disciplined analysis over emotional reaction. If you found this breakdown valuable, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. This concludes our full deep dive into 5 insanely oversold stocks that still dominate their industries. The real opportunity is not in chasing noise, it is in identifying durable businesses when sentiment temporarily turns against them. Thanks for watching, I'll see you in the next one.